Welcome to the deep dive. Today we're tackling a thought experiment, a really fundamental one, actually.
hmm
We want to ask a pretty straightforward question. What would happen if every single adult on Earth decided they wanted to own physical silver? Even, just a tiny amount.
Just a fraction of an ounce.
Exactly. And this isn't about making some wild market prediction. Our mission here is just to explore the math.
Right.
We're using publicly available data, a little bit of historical precedent, and just simple arithmetic. We want to see what happens when you put the sheer weight of the global population up against a truly finite asset.
And that framework is so important. We're just synthesizing the sources, looking at population figures, silver supply dynamics,
Yeah.
and then running a grounded thought experiment to see, where do the numbers actually lead? Because silver can't just be printed into existence.
Okay, so let's unpack this.
So to start, we have to establish the demand side of the equation.
The denominator.
It's the number of, right. And the latest public data shows the world population is hovering right around 8.2 billion people.
Which is just a staggering number to even think about. But we're not talking about everyone, are we? We're focused on adults. People who can actually make an investment decision.
Precisely. So if we narrow that down to the 18 and older demographic, that number is about 5.8 billion people.
5.8 billion.
That's our potential demand base. Imagine, just for a moment, a scenario where every single one of them wants a piece of physical silver.
Okay, so now we have to contrast that enormous pool of potential buyers against what's actually available. And this is where the picture gets, well, it gets a little strange very quickly.
It really does.
There are two very different supply numbers we need to talk about. The first one is the total amount of silver above ground in existence.
So that includes everything. Every piece of jewelry, every industrial component, all the bars in every vault.
Everything. And that number is estimated to be somewhere around, 19 to 20 billion ounces?
Yeah, that's the figure, 19 to 20 billion. And that sounds like an insurmountable amount, right? I think that's what most people assume. If it exists, it must be available.
But that's not the case, because then we get to the second number. The number that really matters for an investor.
The investable supply.
The silver that's realistically available for you to actually buy. So bars, coins, vaulted holdings, and those exchange-traded funds, the ETFs, that are physically backed.
Right.
And that number is, well, it's startlingly low. The estimates range somewhere between 500 million and maybe 2.5 billion ounces.
That is just a massive chasm, isn't it, between what exists in total and what's actually on the market.
Wait, I want to clarify something there on the ETFs. When we're talking about this kind of physical scarcity,
Yeah.
are we talking about the paper contracts or the actual metal backing them? Because that distinction feels really important here.
That is a critical distinction.
Yeah.
And the figure we're using, that 0.5 to 2.5 billion ounce range, it tries to include the silver that physically backs those big investment vehicles. But the broader point is, it doesn't really matter what the wrapper is. The physical metal itself is constrained. People assume that because 20 billion ounces exist, it's all ready to be sold today. That's just not how it works.
So why is that pool so small?
Well, the sources explain that the vast majority of it is already, for lack of a better word, consumed, or at least locked away.
It's doing a job.
It's doing a job. It's in your smartphone. It's a critical, often irreplaceable part of solar panels. It's in medical devices. It's not just sitting there waiting for a new buyer. It's been integrated into our world.
So it's not easily available to someone who just wants to buy a 1-ounce coin.
Not at all. And what's fascinating is just how much of the total stock has simply been used up and dispersed.
Okay, that supply constraint, that tiny investable pool of maybe 500 million to 2.5 billion ounces, that really sets the stage for a pretty explosive scenario.
It does.
So let's launch the core thought experiment. Let's do the simple math and see what happens if all 5.8 billion adults suddenly enter the market.
This is where you really see the pressure.
And we'll start with three really small, tiny demand scenarios.
Okay.
Scenario A, what if every adult wanted just 1 ounce of silver? 1 single ounce. That means we would need approximately 5.8 billion ounces to satisfy that demand.
And right there, that first scenario immediately tells you this is not an orderly situation.
Yeah.
That number, 5.8 billion, is more than double the highest estimate of what's currently investable.
So let's make it even smaller. Scenario B, every adult wants just 0.5 ounce. The demand there drops to about 2.9 billion ounces needed.
Still a huge
And
number.
then finally, scenario C. Every adult wants just 1/3 of an ounce of silver. The total demand there is about 1.9 billion ounces. And to put that in perspective for you, that's physically about the size of a large coin.
A very small amount of metal.
Very small.
So now let's analyze those numbers against that crucial supply figure we established, that zero point 0.5 to 2.5 billion ounce range.
Yeah.
We can immediately just throw scenario A out. The 1 ounce per person, 5.8 billion ounces is just, it's not realistically possible. It blows past the investable supply and starts requiring metal. That is, as we said, doing essential industrial jobs.
Okay.
But even scenarios B and C, the ½ ounce and the 1/3 ounce, they would rapidly absorb most, or maybe even all, of the highest estimate for the investable supply.
And we have to remember, what tiny fraction of the world population actively owns silver coins or bars right now? Is it even 1%?
It's probably much lower. So we're not just talking about a small shift. We're hypothesizing a move from almost zero participation to 100%. It's a staggering shift in demand.
That's a complete paradigm shift.
And that's the crux of it. I mean, if you take the lowest supply estimate, that 500 million ounces, you try to divide that among 5.8 billion people.
You'd get, what, a tenth of an ounce?
Barely.
Yeah.
The physical availability is just terrifyingly thin when you compare it to the global denominator.
And let's just emphasize this one more time. If this incentive shift actually happened, if silver were suddenly seen as real, non-debasable money again, people wouldn't be buying just 1 ounce.
Mm.
If you're trying to preserve wealth, you'd want a functional amount, right? Maybe 10 or 20 ounces.
Of course.
And that just shifts the math from impossible to, I don't know, instantly catastrophic. The sheer weight of that population scarcity is the real pressure point.
So we've established the math doesn't work. The demand can't be met.
Right. But markets don't just, shut down when they run out of something. They adjust, they find a way. So how does this overwhelming scarcity actually play out in the real world?
This is where we have to talk about the mechanism of market rationing. The market doesn't ration a scarce physical good through equal access. It doesn't share.
No.
It rations through price. When demand just wildly exceeds an inelastic supply, the price has to rise until demand is destroyed.
Meaning until enough people are simply priced out of the market.
Priced out, or, and this is critical for silver, until industrial users are forced to find an alternative.
So who gets hurt first when that price starts to really climb? Is it the individual trying to buy a few coins, or is it the huge solar panel manufacturer?
It's both, but that industrial user is actually key to finding the new balance. See, unlike gold, where most of it is just held as an asset.
Right, it's a monetary metal.
Exactly. A huge portion of the annual silver supply gets consumed by industry. Electronics, batteries, and especially solar. And these sectors run on razor-thin margins.
So a price shock would be devastating for them.
Devastating. If the price of silver doubles or triples very quickly, those manufacturers have to react. First, they start recycling everything they can aggressively. Second, they scramble to find substitutes, if any even exist technologically.
And third,
They just have to pause or cancel production. The final product becomes too expensive to sell. And that process, where rising prices force industry to consume less, that's demand destruction. That's how the market finds the ounces for all the new investors.
okay, let's apply that logic to our scenarios. And we have to be really clear here. These are not forecasts. They are not predictions.
No, absolutely not.
This is just applying market logic to the kind of extreme shortage we're talking about.
Simple supply and demand logic.
Let's start with that 1/3 of an ounce scenario. The 1.9 billion ounces needed, that's roughly 80% of the maximum investable supply.
Okay, so to satisfy that kind of demand, you need some serious price action. You need to start shaking people out and, more importantly, start forcing those industrial users to rethink their plans.
So what kind of price are we talking?
You'd likely see the price rise very sharply. I mean, potentially into the hundreds of dollars per ounce.
Wow. And if we move up to the ½ ounce demand, that's 2.9 billion ounces, which is clearly more than the entire investable pool.
Right. To satisfy that ½ ounce demand, you are now actively competing for metal that is supposed to go into production tomorrow.
Yeah.
Or metal that hasn't been economical to recycle yet.
So the price has to go even higher.
It would have to. Potentially into the higher hundreds per ounce. You'd have to destroy significant industrial demand and force substitution on a global scale.
And what about that first scenario, the 1 ounce per adult one that requires 5.8 billion ounces?
That scenario is just a pure physical shortage catastrophe. It would require an extreme repricing, a price rise so severe that it forces massive demand destruction across every single sector all at once.
So essentially, the market has to send a signal so powerful that global industry just has to stop consuming silver.
And put that supply back on the market for investors. That's the only way it could balance.
If we connect all this to the bigger picture, why does this hypothetical scenario with 5.8 billion people even matter?
Because history shows us over and over that hard assets, physical assets, are what preserve purchasing power when a system breaks down. The incentive to own something like physical silver skyrockets when trust in the paper system collapses.
You see this in Weimar Germany, for example.
Absolutely. During the hyperinflation in the 1920s, the paper mark became worthless almost by the hour. And what happened? Hard assets repriced almost instantly to reflect their real value. They became the anchor in a sea of failed currency.
But I think the best historical parallel, especially for silver's role as actual money, is the Roman Empire, the debasement of the denarius.
Yes. It's such a clear, long-term example of what happens when a government abuses its currency.
So back in the 1st and 2nd centuries AD, the denarius was the standard. It was real hard money. Its silver content was, what, 90 to 95%?
It was reliable,
Okay.
and it anchored the entire Roman economy for centuries.
But then, to fund wars and deficits, the emperors started, well, cheating. They started reducing the amount of silver in the coins.
It was a slow process at first, but it accelerated dramatically in the 3rd century, and by the time you get to the middle of that century, the silver content of the denarius had completely collapsed,
To what?
under 5%. And eventually, it went to basically zero.
So you go from 95% silver down to less than 5%. That's more than a 20-fold collapse in the actual intrinsic value of their money.
And the consequence was, of course, hyperinflation. The price of everything, bread, oil, you name it. It soared by several 100% across the entire empire.
And the government tried to fix it, didn't they? With price controls?
They did. Diocletian's edict in AD 301. It was an attempt to impose empire-wide price controls, and it failed spectacularly.
Why?
Because the underlying money, the unit of account, was worthless. You can't command value back into existence after you've systematically engineered it out of the currency.
And that's the connection to our thought experiment, isn't it? Once that trust is gone, 5.8 billion adults, or the equivalent population back then, they suddenly demand the fragile thing.
They don't want the paper IOU anymore. They want the 95% silver coin.
They want the real asset.
Exactly. In all these historical cases, hard money repriced, and it repriced rapidly and significantly as faith in the fiat system eroded, which really raises a modern question. What could be the trigger today?
Mm.
A pandemic, a financial crisis, widespread fears about debt? What would make 5.8 billion people all look for that physical alternative at the same time?
Okay, let's summarize the key findings from this deep dive. The math is pretty clear. Even a tiny fractional demand, that 1/3 of an ounce per adult scenario, it quickly absorbs or even exceeds the entire investable supply of silver. And that points directly toward the market having to ration through extreme price adjustments. The price has to rise to a level that excludes the vast majority of potential buyers, especially from industry.
And we have to reiterate, this whole exercise was just about testing the scarcity math. It was about understanding incentives and looking at historical precedent. We're absolutely not predicting outcomes. We're just mapping the logistics of inventory versus population.
But it does leave us with a pretty provocative closing thought for you to consider. When you think about the fact that 1 ounce of silver is such a small physical object, it's just the size of a couple of coins.
Right.
What does a sheer crushing weight of global population scarcity suggest about the true long-term incentives for holding any physical finite asset? Think about that Roman example again, that 20x collapse in real value. Trust, once it's lost, forces value to flee. And the population math today suggests the container it has to flee into is dangerously, dangerously small. We'll leave that thought with you.